Hello, it's Dave again at AFX Search, licensed investigators in Palm Beach, Florida. Three quick things. Fraud detection. We run a lot of cases where there's been fraud, somebody's stolen money, somebody's had some liability or loss, and clients want to know how to prevent that from happening. Well, here's three types of fraud, and for each one, three things to check to maybe prevent the most obvious types of fraud. Corporate fraud. First thing is check your financial statements. What are the numbers? Are they changing? Is there a line item account that's going up or one that's going down? Is there an expense that's going up that shouldn't be? Is there a revenue item that's going down? That could indicate fraud. Also, percentages. Are the gross profit percentages or one of the line item percentages out of whack for what the metric should be? That's number one. Number two, are your inventory numbers changing? The flow of fast moving items, is it slowing down? Is there one inventory item that is moving too fast where they shouldn't be selling that many? You can look at your gross profit on those. Maybe somebody's wholesaling them out the back door. Number three, activities, habits, and life events of key people. That's usually one of the things that when we look back after a fraud case, what was the motivating factor? The person committing the fraud had something happen in their life that triggered that. It may be a life event, foreclosure, divorce, death in the family. It may be some personal habit that forces them to need money, narcotics, gambling, who knows what. And maybe some type of new activity in their life. So those are the three things. Check your statement numbers, check your inventory numbers, and check activities. That's corporate. Investment fraud. If you're an individual and you've invested in something and you're defrauded by a Ponzi schemer, here's three things to check for red flags to prevent that fraud. Is there any failure of that investment to follow through on commitments? Did they not send a statement when they're supposed to? If the statements are coming in late every month, that means maybe there's something going on. Is the investment secured by real estate? Do you have a deed for that real estate in your hand? Do you have something to show that that company has the property deeded to them? Are there accounts that should be active in their name or deeded or titled in their name? That's number one. Number two is check for errors. If you get an account statement with numbers on it, add them up and see if it adds up to the bottom line number. If there's 8 or 9 or different line items on that statement, add each one up and make sure it totals the bottom. You'd be surprised how many times with a Ponzi scheme or fraud, the fraudster doesn't take the time to add it up right, or there's a addition error. That means it was done manually. If it's done by computer, there are no additional errors. Excel spreadsheet will add it up accurately. Some type of accounting software will add it up accurately. If it doesn't add up, that means it was done manually. That means it was probably created as a ruse or as a prop for you as an investor. Number three, ask for a redemption. If you have an investment and it's a Ponzi scheme or a fraud scheme, it's a one-way street. Investments only go in. If you ask for a redemption or money back and you have any type of resistance or somebody tries to hold back that money or pays late, that's a red flag for fraud. Almost in every case when there's been investment fraud or Ponzi scheme that we're investigating after the fact or doing asset recovery to get that money back, one of those three things has happened, or all three, during the course of that fraud. The investment company failed on their commitments. They didn't send a statement, they didn't send a deed, or there was errors in the math, or they would not give redemptions. Last one is vendor fraud. If you're a business and you have vendors, or you're an individual and you have vendors supplying you with services, those vendors are a source for fraud. You're paying them money. Here's three ways to identify potential fraud. First of all, do they have a P.O. box or a physical address? If it's a P.O. box by itself, it does not mean that they're not legitimate, but it might be a way to obscure or hide their actual location. Number two, Secretary of State. Do they have an actual corporation or a trade name or doing business as or some other type of actual legal entity that's identified with who you're writing the check to? Number three, here's a big one. Is the check signed or stamped? Most companies who are legitimate vendors will have a check stamp. They're processing a lot of checks, they have a stamp. If they're signed, especially if they're endorsed to a third party, that's something to look at. That could be a ghost vendor or somebody who's actually not providing services, just getting checks from your company. So three things on vendors: P.O. box, Secretary of State, and signed checks. We would rather you prevent the fraud than have to hire us or an investigator after the fact to find out how deep the fraud was, how it started, or get the money back. So here's three areas of investment, three things of each one to try to detect, or more importantly, prevent that fraud.